Hi, everybody. Thank you so much and welcome back. We are really excited to be talking about one of the most important issues, I think, when it comes to how we're going to move from goals and ambition to action on climate change globally and also here in California. And that is the issue of climate finance and incorporating climate risk into our decisions. 2020 is the year to talk about this. This has been a year of unprecedented climate impacts, unprecedented but not wholly unpredictable, which I think is important for this conversation. Cloud computing and improved climate science and modeling have really made it possible to better understand the physical climate risks we face across every region of the globe in a very granular and a very specific way. And at the same time, countries, cities, subnationals, states have been putting policies in place under the framework of the Paris Climate Accord that provide a clear framework for the transition to a carbon neutral economy and a new low carbon model of economic development. And as that science and that policy become clearer, an increasing number of financial institutions and regulators and companies are calling for climate risk to be incorporated more clearly and more fundamentally into how we make decisions on investments, how we make decisions on business operations and asset management. And that holds for both physical risk, which is what we're experiencing today in California, the wildfires, also floods, sea level rise, extreme heat, the risk to our assets and investments from those impacts, but it also holds for transition risks, the risk of failing to keep up with or capitalize on this transition to a new economic model. One tool that regulators in particular are starting to embrace and think much more seriously about is this issue of climate-related risk disclosure. So how do we actually ask for more transparency and more disclosure of those risks from companies and from investors across their portfolios? Europe is ahead of the US on thinking through, embracing, and requiring that kind of risk disclosure. But here in the United States, and particularly in California, given our impacts, given our strong commitment to carbon neutrality, we too are starting to think about how to lead in this space as we've led in so many others. We believe California can step in to the American leadership vacuum on climate disclosure and drive ambitious and coordinated and action in this space. So, we've moved the market before here. We think we can do it again. Look at emission standards, light bulbs, distributed energy. Our Governor Newsom's commitment to integrating climate risk into our state investment and asset decisions from his executive order last year at Climate Week represent the next bold step in our leadership efforts. And we're here to talk about what this looks like globally, what different institutions are doing to think through climate risk in a holistic way, and how to start thinking about taking idea to action in this space of climate finance. So I'm thrilled to have with me some folks that we've worked with on this issue and many others, and who are real leaders in this space and on climate in general. You'll probably see a lot of all of them during Climate Week, but we're thrilled we got them all here today on the panel. I have with me Bob Litterman, who is the founding partner of Calpers Capital, but also importantly and recently the chair of the Commodity Future Trading Commission's Climate-Related Market Risk Subcommittee. And they just came out with a report that he'll talk about. Hi, Bob. It's great to see you. I've got Craig Davies, who's the head of climate resilient investments for the European Bank for Reconstruction and Development. And as I said, really moving fast and far on some of the issues we're talking about here. Good to see you, Craig. I've got Divya Mankikar, who's the investment manager for the California Public Employees Retirement System, or Calpers, which, by the way, holds my retirement funds. So I'm particularly interested in what she has to say. And then I've got James Manika, who's the senior partner at McKinsey and Company, and also the chairman and director at McKinsey Global Institute. Importantly, James also is a member of our governor's task force on jobs and economic recovery. And so his role in helping us think through recovery from the moment we're in now and the relationship to these issues is incredibly important. Hi, James. Great to see you.
Good to see you.
I'm going to start with a couple of questions to each of you. Bob, I'm going to start with you. You just had a report come out this past week. I can't tell you the number of people who have forwarded it to me to make sure I saw it. And that was the report on climate-related market risk that you did for the CTFC. And a couple of quotes from that really stand out. Climate change poses a major risk to the stability of the US financial system and its ability to sustain the American economy is one of your top lines. Another is that climate risk may exacerbate financial system vulnerability that has little to do with climate change, including vulnerabilities caused by a pandemic. So I think these are critical points that you're making about sort of the centrality of these issues. Talk about your work, that report, and what you really see as the kind of top line and important messages coming out of that.
Yeah, great. Thank you, Kate. First of all, the report, the fact that it actually happened is already kind of a surprising phenomena. When I was asked to be chairman, I was, kind of surprised. Like, really? We're doing this? Okay. And it was sponsored by the Commodity Futures Trading Commission, and in particular, one of the commissioners, Russ Benham, who was appointed by President Trump along with the rest of the commissioners. And he did a terrific job, both in terms of sponsoring this report, the way it was set up. It was given a broad mandate, which is appropriate because climate risk is not anything that can be overseen by one regulator. This is a problem for all of society. And he pulled together a terrific, and I would say diverse team. Divya was a member of this subcommittee. There were 34 organizations represented, ranging from banks, insurance companies, oil companies, ag companies, data companies, investors, asset owners, NGOs, academics. It was really a wide group. And the commissioner asked us to come up with a consensus document. He basically said, I want a high-level document. He suggested we limit it to 50 pages and focus on what you can all agree on. Well, we got together about a year ago, last summer, not this past summer, but a year ago. And when we sat down and started talking about what can we agree on, I was really pleasantly surprised when at the first meeting, we all agreed, going around the table, we introduced ourselves, and two of the basic points that are key to climate risk management. Number one, we have to create appropriate incentives to reduce emissions. That's the fundamental flaw in the economic system right now. And we all agreed on that. There was no discussion. And then secondly, we all agreed that disclosure of climate-related risks is important and is mandatory. And so we then went on and added some other work streams and got to work. The group, as I say, was amazingly talented. We had a lot of expertise. The entire report, which ended up to be over 3 times that 150-page target that we had 53 detailed recommendations, which it was really amazing, and it was very much a consensus. We wrote a first draft. We sent it around to people and asked them for their comments, not only their own comments from the committee members, but from their organization. So we had the expertise of all of these organizations. We got back basically 1,000 comments, detailed comments from folks who had read it. And we had an amazing editorial staff, I would say, that took these comments, looked at every one, thought about it, and how to address it. We came back with a revised draft. It got thoroughly reviewed by all these organizations, and then we voted 2 weeks ago to approve this report and refer it to the CFTC, and it was published. We've had terrific response to it. As you say, that the main message is, not surprisingly, that the financial system, just like the economy, is at risk from climate change. We've highlighted a number of important aspects of that risk. First of all, you've got to think about all of the potential outcomes. In the financial markets, we have a terminology for this. We talk about extreme but plausible scenarios, and that's what we have to worry about here. We also focused on the urgency. When you're managing risk, time is a scarce resource. And finally, we focused on the fact that we're not pricing risk, and that is the fundamental flaw, and it's our recommendation number one. The U.S. should put a price on carbon, and we state this is the single most important thing that can be done. Because the financial market participants understand, as I do, that financial markets are incredibly efficient at allocating capital in the direction of the incentives that they're given. I spent decades on Wall Street as a financial engineer, taking advantage of, every spare basis point that we could get our hands on while hedging other risks and improving the return per unit of risk. And that's what we're not doing with respect to climate. We've got the wrong incentives. Capital is flowing in the wrong direction toward the old economy, and we need to change that. And we need to have, a lot of capital flow over the next several decades toward the new low carbon, net zero economy. We're going to have to work on building infrastructure and capital that sustains that economy, and we have to do it in a way that is fair and that does not penalize low income and other marginalized communities. So there's a lot of meat in this report. I'm very proud of it, and it's a roadmap, frankly, not just for the financial markets and their participants, but for all of U.S. society. And let me finish by emphasizing one final theme, which is that this is a global problem. We are interdependent. We can't build a wall around the U.S. and keep the pollution out. We've got to work with the rest of the world to harmonize our response. This is just another example, and COVID is another example as well, where it's very clear how interdependent we all are, how our behavior affects others, and that's another important message from this report.
Thanks so much, Bob. And so many themes came out in this report that we'll be talking about with this panel, including pricing, financial markets, the need for transparency and efficiency, and obviously the relationship with the global markets. I'm going to switch things up a little from what I promised you would do, because Divya, you worked on the report and you also just had one come out on your own, your Task Force on Climate-Related Financial Investment report for Calpers. Would love to hear from you. How is Calpers as a major investor, global investor, looking at this space? You have very strong requirements on your returns. How are you thinking about climate risk in the context of that and of your duty to your investors?
Thank you, Kate, and thank you for inviting me to be part of this panel. So yes, Calpers, we currently manage about $410 billion and are the largest U.S. pension fund. But we also have a target of 7%, and we're 70% funded. And what that means is that we're extremely cautious about the risks that we're exposed to. Particularly systemic risks are really material for Calpers. And that's why last year, building on a decade of work of looking at climate change, we really declared that climate change is actually one of the top 3 risks to the fund. And in the TCFD, or Task Force for Climate-Related Financial Disclosures report, TCFD, that we put out in June, we disclose our strategy along 3 dimensions for how we are trying to tackle climate risk to the fund. Importantly, those are engagement, advocacy, and integration, and really working on the CFTC subcommittee, which I was honored to be part of, is one of the ways on advocacy that we are using our voice as an investor to articulate how a meaningful price on carbon and how climate disclosure is important for investors and really critical in order for us to be able to allocate capital in a way that aligns both with, of course, the 7% that we're trying to hit, but also enables us to see where the climate risks are currently really hiding in our portfolio. We've also done a lot of work on integration through carbon footprinting, through creating research partnerships where we're looking at physical risk and not just the sort of what's called transition risk, which could be, market-driven or technology-driven shifts from one industry or sector to another based on a product or service being lower carbon, but really physical risk. And of course, we're acutely aware of the urgency of addressing physical risks in California right now, but we've seen this pop up over the years. And so I wanted to reiterate one of the points that Bob made of how urgent it is that all investors take a look at climate risk in their portfolio, but also that we need help from the US financial regulatory system through mandated climate risk reporting in order to really have access to the information across our portfolio. In public equity, for example, we invest in over 10,000 companies. In private equity, similarly, 7,000 companies. And so unless you have mandated climate risk reporting, not just in the US, but globally, it's difficult to really integrate that as deeply as we would want to, without full access to the information. So I think the CFTC report and the TCFD report that we put out actually really build on similar themes in terms of the need for carbon pricing, the need for climate risk reporting. But also we tried in our TCFD report to show that there is enough data currently to begin taking a look at climate risk. It may not meet all of the thresholds that we would want, but there's a lot that investors can already do to start understanding how they're exposed to not just the risks, but also the opportunities.
Perfect. That is such a good overview of the major issues. And I think we're definitely hearing themes of consistent pricing on the policy side and theme of the need for transparency disclosure. Craig, that's a great segue to you. The European Bank for Reconstruction and Development, you are in fact looking at disclosure very closely and thinking through specific tools that you need to use to move this forward. And I'm proud to say that you first announced your physical risk your physical risk approach at the California Summit back in the California Global Climate Summit back in 2018. So we have a longstanding history with you. Talk about what you're doing and how you're kind of turning this, using these tools that others have talked about and grappling with those at the bank.
Thanks, Kate. It's a pleasure to be able to speak with you today. So as you said, at the European Bank for Reconstruction and Development, we are obviously operating in the European context on the other side of the Atlantic. And there's a lot going on in the European region on climate-related financial disclosure. We are an intergovernmental bank, and we have a particular mandate on helping the markets where we operate make the transition towards being better functioning, more sustainable, equitable markets. And we see the climate transition as being an inseparable part of that transition towards sustainable market behavior. And that's one of the reasons why we're so active in this field, even though we're not a regulated bank ourselves. So we're not held to the same supervisory requirements as commercial banks. But nonetheless, we fundamentally want to do this because we see it as being very much part of our mission towards helping markets to become sustainable. We think it's really important for us to walk the talk. So as well as advising others on how to carry out climate risk assessment and disclosure, we think it's really important that we do it ourselves. And that's why we became the first multilateral development bank to become a TCFD supporter in 2018. And since then, we've been working on our own internal systems for how we can follow TCFD recommendations and specifically to develop an internal climate risk management function within EBRD that looks at both the carbon transition risk and the physical climate risk. Now, that's work in progress. We are expecting to launch that system next year. And incidentally, quite soon, we're going to be launching our very first standalone TCFD report that's going to be disclosing externally EBRD's internal progress on implementing TCFD recommendations. I mentioned that there's a lot going on in the European region. Just to give a bit of detail about that, some of the European national financial supervisors have been very active on the field of climate-related financial disclosure. I'm sure you all know that it was the then governor of the Bank of England, Mark Carney, back in 2015, with his landmark speech, The Tragedy of the Horizon, who really in a sense, made mainstream the debate around how financial markets really need to start internalizing climate risk. And since then, the Bank of England has been very active in pioneering work on integrating climate risk into financial supervision. So here in the UK, the Prudential Regulation Authority in spring 2019 issued its supervisory expectations on climate risk that apply to every financial institution in the UK. There's been similar work in France, led by the Banque de France, and in the Netherlands by the Dutch central bank DNB, and more recently at the European Union level, the European Central Bank has currently out for consultation at the moment its climate risk guide, which is due to be finalized by the end of the year, which is a big step towards mainstreaming climate risk into the European Eurozone financial supervision system. So these are all big steps forward that the European financial regulators are taking. There is also an outfit called the Network for Greening the Financial System. This is a coalition of more than 60 central banks and financial regulators from all around the world. There's a strong European representation, but it's very important to point out that this is a global coalition. And we have also financial supervisors from emerging markets, including, for example, the People's Bank of China and many others from pretty much every continent of the world. There is some USA participation and engagement in these fora, which is really important. And I'm certainly, I think we all hope to see more of that as time goes by. And for example, the Basel Committee on Banking Supervision has this year launched a task force on climate risk, which is co-chaired by Kevin Styro from the New York Federal Reserve. So it's really important to see that the US is part of these discussions, even though a lot of the debate is taking place in Europe. Just a final word on what we're doing at EBRD. As a multilateral development bank, we've been working on climate for 15 years. So there is a wealth of experience that we and the other multilateral banks like the World Bank and the others have on climate. So we're trying to see how we can help to feed in some of that experience to the work that the financial supervisors are doing. EBRD is a very enthusiastic observer of the NGFS, and we're involved in a number of their technical work streams, and we've been supporting the development, for example, of things such as the NGFS Climate Risk Handbook. But one last point I want to make, that I think it's also really important that we, as a transition bank, support our clients in understanding this evolving supervisory context. That means our clients, both in terms of financial firms and also non-financial firms in the real economy. And I think we always have to remember that link through to the real economy, because ultimately where these climate risks become material is in the real economy. The firms that are out there, producing goods and services, maintaining and building infrastructure assets. And the financial system always has to link through to those real economy firms. So what we're trying to do as well in our investment operations is to support our real economy clients in understanding how the expectations are changing in relation to climate risk, and how they need to be generating the information about the real climate risks in their operations that then can be taken up by the financial system and meet the expectations of the financial regulators. So, the regulation needs to take place, the supervision needs to take place in the context of how the real economy is going to be affected by climate change impacts.
Thank you so much, Craig. And I will say that you don't need to convince Californians that climate risk affects the real economy. I often say, one of the things that's driven our administration is the first week of the Newsom first term was the week that PG&E declared bankruptcy, and the ratings agencies soon followed with downgrades to all of our utilities. So we are very much living the impacts of climate risk on the real economy here. James, I'm going to turn to you, and partially for a global perspective, because I know so much of your work with the McKinsey Global Institute really is looking across systems. But also McKinsey has been, a leader on the clean tech side for a long time. I think we all know the McKinsey cost curve. I think we've all internalized that. You've done a lot of work on sort of thinking through the opportunity side. What got McKinsey focused on fairly recently on physical risk, on these physical impacts and the impact on your clients in the financial system, and particularly, why last year at this time you stepped up to join the Coalition for Climate Resilient Investors? What was that thinking process for McKinsey, and how do you think about these issues?
Yeah, thank you, Kate. Yes, we have been involved in climate research and climate work for quite a while. As you pointed out, back in 2006 and 2007, we did the carbon cost abatement curves. And I think they found their way into the Stern report, which came out in 2007. And so we've been working on these issues for quite some time. I think as we continue to do this work, we found that in fact, these issues of risks, especially physical risk, involving firms and companies in the real economy were becoming more and more real. And in fact, they were starting to affect, as climate events became more frequent and also more intense, these issues were finding themselves quite evident in the increasing the exposure of many of our clients. So we actually spent some time thinking hard about the effects of climate on physical risk. So as you pointed out, we were working over the last 2 years, for example, doing research on climate physical risks especially, but also thinking about the socioeconomic impacts. In fact, we published a report at the end of last year. I think Larry Fink ended up featuring it in his annual letter to investors. And part of that was also driven by the fact that we were starting to look at both the systemic impacts. So for example, we spent a fair amount of time doing research in about 9 regions across the world. And what we were trying to understand in those case studies in that research was how these kind of physical risks manifested themselves in the real economy. So we looked at, for example, value chains and supply chains and the impacts on those. We looked at things like sectors like agriculture, like the exposure that residential and commercial real estate, how exposed it was to these physical risks. We even looked at things like health and labor productivity. One of the things that is under discussed, in our view, is the impacts on health and workability and labor productivity, because there are some regions where we may be getting close to physical thresholds for how long human beings can actually work in the open, and those kinds of considerations. We looked at the relative concentration of exposure to these risks in sectors like agriculture. So we've been thinking a lot about these questions as a research question. And as we continue to work on this research, we found that many of our clients were very interested in understanding these issues in terms of the systemic exposure that they're exposed to, but at the system level, but also at the subsystem level. The subsystem issues are particularly important because they tend to operate at the level of sectors and regions and firms, and each of these have their own participants in those ecosystems. And those participants are not just the financial actors, the banks and the insurers, but also actual real companies, small and medium-sized businesses, farmers and households. So we were trying to understand these issues. So we found ourselves and ended up helping a lot of our clients. And let me describe the kinds of things that we're doing with many of our clients, most of them in the real economy, although some of them are financial institutions. So with financial institutions, that is banks and investors and insurers, we're helping them understand how their levels of exposure, and also even helping some of them do stress tests. So we've actually worked with some banks, including kind of national banks, central banks, some of the work we've done with the Bank of England, for example, Marconi and others, just understanding and helping them do their stress tests around just what is the level of exposure. We spend even more time working with firms in actual sectors, looking at, again, their particular exposure given their supply chains. And retail and manufacturing are particularly important because if you think about retail, think about some of the largest retailers you can imagine. Their supply chains span the globe. Some of the biggest manufacturers in automotive and other sectors, they span the globe. And also, we've also been working with firms that I would characterize as kind of firms with very large labor-intensive and very diverse footprints. These are companies that employ a lot of people. And so therefore, they have to think about the impacts of their people, particularly if they're in agriculture or, as I said, in retail. The other thing we're also helping firms do, Kate, is to think about how they can decarbonize their operations going forward. And we've spent a lot of time thinking about if we're going to be on, depending on which pathway you're looking at, whether it's the 2 degree or the 1.5 degree, and what does that actually look like for them? What could their pathways actually look like? So this is a lot of the work we've been doing, and increasingly it's now also started to involve how to think about disclosure. So I'm glad we're actually talking about disclosures and as well. But I want to point out, and I'm hoping we'll come back to it. One of the things in our research has been to really think about and communicate to people just how regressive these climate effects are in terms of impacting vulnerable populations. You can see this on a global level. If you look at it, tends to be the poorest countries in the poorest regions, and even within those countries, it tends to be people fairly low down the socioeconomic scale. But even in places like California, this is not just a developing world issue. I mean, it's quite striking that if you look at, the extent to which, people who are underinsured, they tend to be poorer people who have to work outside. We have a very large agricultural sector in California. People who are, in communities of color, for example, we know that some of the places where the air quality is the worst also tends to affect poorer people. So these are very, very important issues we've started to spend time on.
We definitely will come back to that. I think that is a critical issue and really tees up an important conversation, not only about unequal impacts, but also about what is the impact of increased attention to these issues by investors on areas of the world that are already suffering from many of these impacts. Do we see a lack of investment in those areas? What does that start to look like? So we'll talk about that in a minute. Before we get there, I think wanted to just spend a couple minutes with all of you on, you've talked sort of about getting from this very high level, we talk about 2 degrees, we talk about emissions globally, but really getting that down to a real economy and a financial system conversation, which all of you have done really brilliantly in your different roles. Also, though, getting from sort of the question of the science and the economics to what you said, James, which is really true, that this affects specific local areas and regions and sectors very differently. So it's very granular, ultimately. That's something that the Task Force on Climate-Related Financial Disclosures tries to capture in terms of sort of that translation to the financial system, and also really getting to that asset level and investment level on decision making. I'm really interested, and I'm going to start with Craig and then branch out. Looking at the Task Force on Climate-Related Financial Disclosure, TCFD system, both of you have used that as a framework. What do you think are the most useful and critical pieces of that framework? There's a governance piece, there's a disclosure piece, there's a lot of different ways into TCFD. What do you think when you're actually talking to your investors and to shareholders and to folks out in the financial world and the real economy, what makes the most difference in terms of that framework? Craig, I'm going to go to you first and then Divya.
Okay, I mean, I think talking about the 4 layers or 4 pillars of the TCFD recommendations, you can't really pick them apart. I mean, it's a system and they're all important. But I think to kind of answer your question in a bit more depth than that, what we observe is that there are 2 areas in particular that are triggering lots of debate. One is scenarios and the other is metrics. So let me start with scenarios to start with. I think the TCFD is quite clear on the importance of scenarios. I also noticed that the report that Bob and his colleagues worked on recently as well, that also makes this point very clearly, that scenarios are a very important set of tools, a very important approach for recognizing explicitly that there are big uncertainties. I mean, there are big uncertainties in the way that the economy, that the financial system is going to be affected by climate change over the years and decades ahead, and how on earth can firms, both financial and non-financial firms, carry out effective risk management in that context of uncertainty. So the scenario approaches are hugely important, but also triggering a lot of debate. What we've seen, for example, is in some of the discussions, we've almost seen financial firms waiting to be told what to do by financial supervisors with respect to scenarios, waiting for the supervisors to tell them, okay, these are the scenarios that you need to use. And also looking for a degree of standardization in scenarios that I don't think is ever really going to arrive. Now, if you look at what the Bank of England did earlier this year, they issued their biennial exploratory scenarios, BES, Now, that was issued at the beginning of the year in January. It was meant to be rolled out this year. Then sadly, because of what's happening globally with COVID-19, this has all been pushed into next year. But nonetheless, it's a really important piece of guidance to read. And it sets out a number of high-level policy scenarios, if you like, or scenario narratives based on the notion of no policy responses to climate change, an early policy response to climate change, which is the more optimistic scenario, that we get our act together pretty soon and start pricing carbon, start implementing the sorts of policies that we need to see. And then there's the more pessimistic late scenario narrative, where yes, there is a policy response, but it comes late, possibly too late. Now, beyond that, beyond those sorts of high-level scenario narratives, I think there is a degree to which it's going to have to be up to firms themselves to work out exactly what sort of scenarios and assumptions they make that affect their business operations. And I think also within scenarios, there are multiple different types of uncertainty. You have policy uncertainty. And we don't know how governments are going to shape carbon policy in the years and decades ahead. There are different possible outcomes. That's driven by politics, it's driven by society. But we also have sort of real physical and modeling uncertainties in our limited understanding of how the climate system works. So bundling these, managing these different and very complex sources of uncertainty in scenarios is hugely challenging. Metrics, I don't want to take up too much more time, but I think also we're seeing a lot of interest around the specific sorts of metrics and indicators that need to be used in climate risk assessment and climate scenario and climate disclosure. Firms are looking for guidance on this topic. And I think what we've also seen very interestingly, if you look at the example of the European Central Bank's climate risk guide, which is out at the moment for consultation, there's been some really interesting feedback, and you might even say pushback from banks, so pointing out that some of these metrics are maybe really ambitious in terms of what banks are currently collecting information on. So I think on those 2 points, scenarios and metrics, those are two areas where there is a lot of debate and a lot of work to be done in rolling out TCFD.
Really good point, and I think goes to that particular issue of disclosure as well, which is if we've got these levels of uncertainty both on the transition and policy side and on the physical side, how do you translate that not only, as you said, into scenarios, but what are you asking people to disclose? We've talked in every conversation all of us have been in, I'm sure, on this issue about disclosure, and Bob, you in particular just talked about this in your report, I know. How do you translate those levels of uncertainty into meaningful disclosure? I will say we all probably know Spencer Glendon, who was at Wellington for a long time. He would say there's less uncertainty in this area than in many areas that the financial system does already look at as material risk. But that aside, how do we do that kind of translation? Bob, but also, of course, James and Divya, anyone jump in on this, but Bob, real quick reaction first.
Well, I certainly agree with what Craig outlined, and we do dig into that a little bit in our report. I think what's important to recognize is that there's many different users. So you've got asset owners, you've got investors, you've got corporations, and government, and there's different levels of risk. So you've got the systemic risk that regulators and society need to worry about, but you've also got the risk to individual companies. So as an investor, I might want to be short stranded assets, but I might want to be long some companies or countries versus others. And so I need to know different kinds of information for different kinds of decision making. So it is complex. Where we're at today in terms of global disclosure is at a very early stage, and we need to move forward. And that requires leadership by the regulators as well as asset owners and investors. And all of this is coming together and moving forward very quickly, I would say.
And so some of it is folks have to start doing it and seeing how it works is sort of what I'm hearing from you. James, Divya, James, did you want to weigh in on the disclosure question, and Divya as well?
Yeah.
Sure. So I can talk about our decision to go forward with a TCFD report. One of the things that I think we had to really develop the capability to manage is, just as Craig and Bob said, the scenario analysis. And there are a number of different tools for investors to look at really the public equity portfolio primarily. What we found, and is in the report, is that over the next couple of decades, our portfolio trends with the same emissions trajectory as the global economy, which is about 3.2 degrees. And that's not surprising. As I said at the top, we have a 7% hurdle, we're 70% underfunded, and that means in our investment approach, we're highly diversified, trying to capture market return where we can get it. However, we are also, engaging companies to disclose not only in line with the TCFD report, but with a real focus on how their board has oversight over their climate strategy. In terms of your question of what are investors looking for,
and the governance piece, you're asking for disclosure on the governance piece as well, is what I'm hearing you say.
Yes, governance and on targets, and so. Our sort of premier collaboration on that front is Climate Action 100 Plus, which Calpers helped to convene, but is really a global network of 500 plus investors now representing more than $47 trillion in assets. And we engage 161 companies where so far 120 of those have nominated a board member or have a board committee explicitly responsible for oversight of climate risk. There are 50 companies that have indicated that they'll aim to achieve net zero by 2050. And there are 59 companies that have formally supported the TCFD disclosures. Many of those have already become started reporting in line with the TCFD. So I think sometimes the conversation about disclosure can be a little bit nebulous. And Climate Action 100 Plus helps us to demonstrate progress on these specific elements of disclosure that are really important for investors to know that A, we're mitigating our exposure or trending towards mitigating our exposure through the target setting of the companies, but also that over the long term, as we're a long-term investor, they're putting in place oversight at the board level so that this strategy, survives different board iterations and different, market cycles.
Thanks, Divya. And James, you wanted to weigh in on this disclosure point, and then I want to turn to you on a last question as well. Go ahead.
Yeah, I was going to comment to point out that one of the things that makes this very complicated, particularly when you look across countries and across sectors, is the fact that there are often very different standards and very different systems of disclosures. And so for many companies who are or even investors for that matter, who are multinational in different sectors across different countries, there's going to be a need to harmonize and standardize just how we think about what is being disclosed and what that information looks like. The other thing that's also important is there's always this tricky balance between what I think of as private disclosures versus public and competitive information, particularly for firms who are in the real economy, where they may have a different asset exposure and profile versus another firm. So there's these kind of competitive questions to think about as well. So more work is required, I think, to make this all work the way we would like it to work.
And I think I'm hearing from all of you really, and a clear role for government. I mean, there's a need for standardization. There's a need for direction, because as you say, James, and I think we've all seen this, especially small firms cannot deal with multiple layers of disclosure of multiple types. It's very challenging. How do you rationalize, right? And sort of look at this across the real economy and globally. I want to spend our last couple of minutes, James, coming back to something you talked about and starting with you, and we may have to end up ending with you given limited time, sadly, but you made this point about unequal impacts of climate, both I think on the kind of physical climate risk side, but also of course, emissions, pollution, air quality, water quality. I'm also interested in your thoughts on how do we avoid the potential negative consequence of sort of in this perfect system we're describing where everyone discloses everything, isn't there a risk that parts of the world and parts of the United States and frankly parts of California no longer get a significant amount of investment because they're just seen as a bad bet? How do we, from a risk perspective, how do we avoid that? How do we start thinking through that ahead of time so we don't get run over by it? James?
Yeah, and I think this is a very important question because of these regressive effects we just talked about. I think part of that is to make sure we think through, we have a through line in thinking about the systemic impacts of this. So it's not just that people live close to places where we're close to physical thresholds, but it's also the fact that often their livelihoods are touched by activities on assets that often gets disrupted by climate change. So think about agricultural workers or people working very close, or even in sectors like tourism, and also the effects that might also even have on asset prices for residential and commercial real estate, if in fact those values get affected by fires, as we're seeing, or other things. So I think part of how we avoid that is to make sure that we think through how our actuarial systems and insurance systems work, who underwrites the value of those assets. How do we make sure that, in fact, we don't then discourage businesses from investing in physical assets in particular places, but also how do we make sure that also doesn't end up impacting tax revenues for states and so forth. So I think part of that is making sure that there's clarity as to how those risks get managed and whether, in fact, and who might get left holding the bag. I think this is particularly difficult for states because many of the systems that should do that operate at the federal and national level, but at the state level, the tools available for states to manage this. So I think this comes back to the importance for policy clarity, the importance for almost national level policy direction and systems to make sure these subnational issues don't get out of hand.
Perfect. James, I think that point you just made about kind of the role of states and subnationals within a larger global context, especially with the interactions among these systems, is a really important one. I'm interested, Craig, in your thoughts, because you're working within a system as well, which has a governance structure of the EU over a number of national governments with extremely diverse issues and approaches. What do you think the role is of sort of nations and states within this larger global system when it comes to disclosure and risk?
I think there are a number of really important crossovers there, and I think I've got three things in my mind. The first one is policy, and I think we talked earlier about scenarios and how one of the big drivers in scenario uncertainty is policy uncertainty. So there's a really important role for the public sector, including at subnational levels, to provide the clear policy signals. So, for example, carbon pricing. Giving that certainty on policy certainty on carbon pricing is really important for enabling firms to be able to develop meaningful scenarios that guide their future performance. Even in other ways, in California, for example, you have world-leading legislation on groundwater use, which we've looked at very closely because it's a great world-leading example. Now, having that policy framework in place for groundwater use is really important for firms who are exposed to climate-related risk through their use of groundwater. So policy is really important. Another is analytics. There's a really important role for the public sector, including subnational, going right down to municipalities and county level on, for example, flood risk mapping. Providing the analytic data that companies and financial markets need to make well-informed decisions about climate risk. And I think the last thing to say is, in our experience, is that capital markets can also be local. In many countries, you have devolved financial supervisors. You also have, for example, things like stock exchanges, which may be very local, but they can still play a very important role in directing capital towards, climate smart investments, climate smart indices or ESG indices in stock exchanges. Can have a really important impact on the flow of capital, but they're devolved. They're not necessarily part of the big overarching national or federal structure. So there are a number of ways in which subnational entities can have really important roles.
Thank you so much, and I wish we had more time on this question and many others. But what I'm really hearing a common theme from across of you all of the role of policy certainty, and the role of government. And I will say, as the fifth largest economy, a nation state, as our governor likes to say, in and of ourselves, California really does think of ourselves as a leader in this space. We do have certainty of a policy in a number of areas of climate change, and we're looking very, very hard at this question of climate finance and risk disclosure. So thank you all for being our thought partners on that, leaders in your own fields, and for participating today. Really appreciate all of you, and we will all continue talking as we go forward. Thanks so much.
Thank you, Kate.
Thank you for having us.
Thank
Thank
you.
you, Kate.